National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
On today's show, Charitable Giving 2011 with CPA Ken Davis.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, welcome everyone to the Business Insurance Zone. We're broadcasting live to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. We're with Ken Davis, CPA, CFP, CLU, ChFC, Day 2, Ken.
Hello, Stephen.
Well, I'm telling you, it's Merry Christmas, Happy Hanukkah, Happy Holidays to all of you. We're in a charitable kind of mindset. We're going to be giving. We're going to be benevolent today. We're going to be talking about all the tactics. And one of the big ones we're going to talk about all this week, but today especially, charitable gift annuities. Or I like code. We're not going to try to use acronyms. I promise myself I'm not going to try to use acronyms on the show, okay? But charitable gift annuities, but some people use the phrase, CGA, so they're pretty popular, by that. Ken, when I think about annuities and I'm thinking about charitable gifts, am I just giving my annuity away, or is this a whole nother tactic?
It's a whole different kind of a tactic. What's happening here is the donor, the person giving to the charity, gives a lump sum of money, maybe 25, 50, 100,000, $500,000, whatever, to their favorite charity in exchange for a lifetime income. So in this case, really, the charity becomes the insurance company.
But now, do they get anything for making the contribution to the charity?
Yes, they do. And what's interesting, it's kind of a split interest gift of sorts. They are giving a charitable element, and they're getting income. So how does the government determine what the deduction is? Well, basically, let's say that you had, here I've got my chart for a 70-year-old person. They would get 5.1%. So $100,000 would be $5,100 a year in income. Well, we all know that at that age, you could go out and buy a commercial single premium immediate annuity and get a higher income flow off of it. So the IRS says, you're giving up part of your income. We're going to give you a valuation of what that lump sum of money is as a deduction. And so they get to do it on the return subject to the adjusted gross income limitations.
Now, is that the income? Their income is what gets a little bit of favored or tax advantage.
Well, actually, it's two things. They give you a lump sum deduction for that,
for the original,
right?
Original donation,
right? And so they get to deduct that. And then what happens is, just like a single premium immediate annuity, what happens is we amortize basis over our lifetime on a straight line basis. So if we have a 20-year life expectancy, we would have 5% of our gift. In the 100,000 case, 5,000 a year would be a return of principal and tax-free. Anything in excess of that is taxable. So we get both the amortization of basis to reduce our current taxation on that income, just like we normally would, and we get an upfront deduction for the charitable gift annuity to the charity.
Now, where's the charity getting the income to give you this? They're not, because they want to keep the principal intact, right?
That's right. And I'm going to caution our listeners that charities have to be careful about playing this role, because what they're going to do is take that money, that $100,000, they're actually going to invest it somewhere, presumably in some sort of a mix of stocks and bonds or whatever. And there's actually an organization out there that does calculations of what should be given based on current interest rates and market environment, whatever, as an appropriate gift, and their calculations are based on the assumption that when the client eventually passes away, about 50% of that seed money will be left after they pay interest and some principal to the donor. But in one particular case, one of the churches I work with said that their average was more like 80%. So while it's conservatively calculated for 50%, it actually is 80%. So that's where the gift comes, is ultimately what's left over goes to the charity when they pass. In the meantime, they get a lifetime income, guaranteed.
So they know they're going to be giving up something in advance if this has a normal, whatever the life expectancy of the donor is, or whoever this life is calculated to.
Right, and here's where I get really excited. Think about, you've got a 70, 75, 80-year-old person, highly conservative, can't make income anymore, doesn't want to take risk in the markets. So a lot of them, where do they have their money? Well, they've got it in, money market funds, bank CDs.
That are paying nothing.
Yeah, 0.3%, less than 0.5%. So think about it, $100,000. Let's be generous and say that they're getting 0.5% per year. $500 a year to live on if they leave that seed corn alone, just leave that principal alone and live off the income. It's disgusting. So suddenly you show a 70-year-old person, hey, I can pay you, your charity will pay $5,100 a year, partially tax-free income and a deduction up front, compared to $500 a year that's fully taxable. I mean, this is a no-brainer. This is an opportunity for the small donor to have an impact, to improve their life. I mean, wouldn't it be fun to take one of those middle-class clients that you have and say, gosh, I can improve your life? I mean, if a widow can get an extra $400 a month to live on after taxes, I mean, that can be a life changer for some of these people on fixed income. And at the same time, they love their charity, their church, their synagogue, whatever it is that's important to them, and they get a lot of joy and pleasure out of being involved in these organizations, that they can go to the head of the organization and say, I'm going to give you a charitable gift that is going to help fund the church or charity or synagogue after I pass away. Tax deduction, partial tax-free income, and the good feelings of helping a charity and helping build up an endowment for future funding.
Now, is this pretty, do you think that charitable gift annuities, everybody pretty much in our area should know this, but I don't think we do.
No.
I think the advisors, how do we do this? How do we play? How does this work? And I think, again, we're going to have this out on our site. Kind of a special landing page. It's going to include all 5 of the video series. It's going to include Ken's 2010 report. You maybe want to show them that too, Ken, why we're doing it. A 20-page study on high net worth. This is going to be huge. And then I'm also going to put out there a whole thing on charitable giving that we use off one of our vendors. I think it'd be really armed to the teeth. And part of that document has a lot on charitable annuities like this.
Well, and the beauty of it, what we have planned for one of our later segments this week, so our listeners want to tune in, we're going to give them resources that makes this whole thing a no-brainer. There's JDs, attorneys, accountants, all kinds of people out there that will work for free to help support these concepts, give you literature, brochures, information for yourself, for your clients, whatever, and make it very simple to give. And your major charities do this. We're going to talk about community foundations later this week. And then you might even bring yourself up to speed to be able to do this. And there are some technical issues, but they're easily taken care of. There's plenty of resources out there to get this stuff done. It doesn't take long to learn what you need to know about charitable gift annuities.
Attorneys working for free, I mean, I've lived to see the day. So,
well, they work for us for free. They get paid by their organization.
Oh, there you go. Okay, I knew it couldn't be all free.
Of course not.
Well, when I'm looking at this, I'm looking at some of the, you've already laid out some of the tax benefits.
Right.
And now we're talking a little bit about, is there any limitation on how much I can do this as a taxpayer? Because I know Uncle Sam is just going to let me do what I want.
That's right. And that's important that people understand that there's different rules. We've talked ad infinitum about adjusted gross income, that number on the bottom of the first page of your 1040. That determines how much of your charitable contribution is deductible. Okay, so before anybody gets too excited about it, make sure they've got enough adjusted gross income to absorb the deduction. The general rule, and as we've talked before, we get general rules and then exceptions to the general rule and all that stuff. The general rule is about 50% of your adjusted gross income. So if you have an AGI or adjusted gross income of $50,000, and the maximum contribution, deductible contribution in a particular year is $25,000, which is half the 50. If you have other types of less favored charities, it can drop to 30% of adjusted gross income. And if you're giving capital, highly appreciated capital assets, there is a 30% limitation, 20%. And you know what? That paper that we're offering to send them, there's a nice little sheet that in one-page summary goes through all of those different details and how it works. If they need more detail, again, going to these resources we're going to give them will tell them, is this the right kind of charity? What are the limits and that stuff? And even more important than that, as we talked in our show last week on tax planning at the end of the year, is you got to run it through some software. You can't just say, hey, the AGI is here, I should be golden. No, you can't. We got alternative minimum taxes. We have adjusted gross income changes. I mean, there's all this stuff flowing through the return. And the best thing is to work with your tax advisor to run it through some tax projection software. Make sure, in fact, you're going to get the tax savings you think you're going to get.
Now, I noticed that when you were talking about the limitations on AGI, and we're trying to look at some of these things, I noticed that you talked about a little bit about gifting appreciated stock. You know, you just mentioned it in passing, and I'm thinking of people who have stock. First of all, they're loser stocks anyways, right? I'm just saying, if they had, would it be good to give away I mean, after I've done my capital gain, capital loss, after I've done that, and I don't want to keep forwarding this on forever, right? My losses. Is there any tactic or strategy to move this to a charity and just gift stock that's loser?
Well, yes, and I want to see you get excited again. We talked about tax harvesting last week,
I love
right?
tax harvesting.
Well, first you look at your capital gains, your capital losses.
Right.
You sell them to create and have them offset. But then if you need more tax planning or you really want to do charitable giving, you can take appreciated stock, assuming people have appreciated stock out there at this time, and instead of, let's say you had $100,000 of stock, you had $10,000 of tax basis because you bought it 30 years ago. So you'd have a $90,000 capital gain, 100,000 minus 10, right? Well, if you did that and you paid taxes on it, then you're not going to have 100,000 to give to the charity, are you? You're going to have the 100,000 minus your taxes, and then you give it to the charity and you get a lower deduction for that lower amount, right? Well, here's the cool thing. The government, if it's to the right kind of charity, you can give the whole $100,000 to the charity and get a whole deduction for the $100,000 up to your AGI limits. And then guess what? The charity now has the stock. What do they do with it? Well, they're a charity and they're not taxable, are they? No. They're a tax-free entity. So they take and sell it, and there's no taxes to the charity on that $100,000. So you avoid immediately paying the capital gains. All right, now it's a little more complicated than that, and you don't get totally off scot-free on the capital gains. What happens then is, as you receive that income, in our first example, we get part of it is tax-exempt income, return of principal, and part of it is taxable. Well, now we have a third element. As you receive this payment, the third piece is a portion of that capital gain comes in each year. But as our financial advisors know, time value of money is important. So if you can defer the taxation many years out, that's valuable to the client not to pay current taxation.
Now, but losses, though, is there any reason I should send a loser fund over?
No. You should sell it, take your loss, and then give your money.
Okay, that's what I'm looking
Okay.
for.
Right.
Okay.
All right. Now we're there.
I was like, oh, well, appreciation. I appreciated stock part. I'm looking about my losers. And I don't know about you, but my portfolio has not walked through the asset allocation of Monte Carlo perfection, I have to say.
But there's a $3,000 limit on tax deductions, remember, for cap losses.
I knew there'd be a limitation because Uncle Sam's, he's the Grinch. He's not going to let us do what we want to do. Well, listen, you've been listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. You can email me at my email address, thebiz@brokersalliance.com, or call me direct, 1-800-290-7226, extension 147. Ken and I will be right back after a word from our premier provider of guaranteed term and guaranteed universal life, Legal and General America.
Banner Life Insurance Company and its subsidiary, William Penn Life Insurance Company of New York, comprise the Legal and General America companies, part of the International Legal and General Group, one of the largest insurance companies in the world. Now, Legal and General America is one of the top-rated insurance companies in America, with one of the strongest financial balance sheet among its peers. Legal and General America is a major player in guaranteed term and guaranteed universal life, and consistently ranks among the best carriers in almost every product spreadsheet. Legal and General America's product line of guaranteed universal life endows at the maturity date, while most carriers' cash values just zero out. You know the reputation of Banner? Now know the value of LGA, Legal and General America. The power to protect, the power to preserve, the power to serve their policyholders. That's Legal and General America.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant, insurance columnist, financial color commentator, and some people say interviewer extraordinaire. I'm probably the only one that says it.
I think so.
Yeah, probably. Hey, remember, before moving forward with anything that we talk about on the show, especially the strategies of this week, always talk with your CPA, your tax attorney, and your broker-dealer compliance department. Hey, before you do anything with life insurance, annuities, DI, what else do I sell? Group pension plans and long-term care. Just call us 1-800-290-7226 and we'll do a quote for you at extension 147. It's not what I know, and that's why I have only the best on this show. Ken Davis, Ken knows, CLU, ChFC, CFP, and CPA, and SL. Well, okay, there we go. All right, Ken. Well, I'm trying to be a good guy.
Those are your initials, Steve, that last one.
Yes, it is, probably. Well, we're talking about holiday planning, and nothing says happy holidays than charitable giving. And we're talking about charitable giving, and when we talk about it, in the first segment, we kind of honed in on charitable gift annuities, and we're still going to touch on some of that on the second segment. But I want to get something up and out of the way because we really don't address this too often. And I don't want to get into using acronyms on the show because I was going to say WRTs, but I want to get into wealth replacement trusts. Now, this idea of replacing something I'm giving, right? Which I heard somebody tell me the other day, well, then if you're replacing the thing that you're giving, you're not really giving. And I say, okay, fair enough, tag me, right? Send me a ticket, in eternity, just tag me later on. But actually, I think a lot of people appeal to this. Wow, I can give and replace what I just gave back. I love that. Talk a little bit about that.
Well, there's several ways of looking at that. The way I look at it is planned giving. Planned charitable giving has to do with utilizing tax laws to their maximum for the benefit of the donor. And if we can move tax dollars to the charities instead, I love that. And the Wealth Replacement Trust concept is simply you're giving away to charity. And let's start with an IRA that even somebody without estate taxes could end up giving 40% to the state and federal government. So $100,000 becomes $60,000. So what you can do is you can actually take other assets, gift them to a trust, just like an irrevocable life insurance trust, make payments each year or a lump sum, have the trust buy the life insurance policy, then it comes out estate tax-free and income tax-free to the children. And there still may be a gift element. You still may be out of pocket, and people have to be charitably inclined. But we can take the sting out of the giving. And in fact, we hear about these massive gifts by Bill Gates and Warren Buffett and people like that. And what a lot of people don't understand is they're doing the same kind of thing. They're taking those tax savings and they're actually using them to replace or rebuild their wealth or to go out and buy life insurance. In this case, let's talk about a charitable gift annuity. We talked about that in the last segment. Let's say you gave $100,000 away and you're going to get a $5,000 a year income. So it's a partial gift, not a full gift. And you get a partial deduction for that. Well, let's say, I forget exactly the statistics, but for a giver, I think the numbers were like $14,000 in tax savings, and they turn around and make a lump sum purchase of life insurance. Well, instead of giving it to the kids, they can actually double up their giving. They can actually go and buy, say, a $250,000 life insurance policy, and maybe more with a second to die.
Which might have been freed up. Those funds were freed up by the tax savings.
That's exactly right.
Yeah.
You take your tax deduction, you get tax savings, and then you can either keep it, give it to the kids, or you can turn around and then re-gift that and get a double, giving type of thing. So in that case, you really are giving, your friend who was sending you the bill.
Right.
In that case, you can turn around and double gift on that. So there's this money that's saved by taxes can be used in a number of ways.
And just a heads up, there are many charities in the United States, and I'm thinking about one that I had just contributed to myself, that actually will match your contribution. There's entrepreneurs that are inside the board of directors, a lot of these people, that say, hey, listen, for the next 30 days, if you want to throw it, whatever, dollar for dollar, we'll match it up to whatever the number is on the ceiling. And that's what I really like as well, because now we did what you just said for the individual gift or the donor, right? And now the donor says, oh, whatever I gave, now is going to be matched by some really big philanthropist, like some of these guys like Bill Gates or somebody like that.
I was thinking about this the other day as we prepared for the show, and I was thinking about these new linked long-term care policies like annuities. And in this particular case, there's no deduction up front or tax benefit, but they can still gift it to charity. For instance, let's say somebody says, gee, I've got this annuity and I probably won't use it, but I really want to know that it's there. And what if they took a regular annuity, do it a tax-free exchange into one of the new linked annuities with LTC? And let's say that they say, well, gee, as long as I live, I want to know the cash is there for me. And if I need long-term care, I can get tax-free distributions on the rider. And then when I'm done, it's going to go to charity. So there's no current deduction or benefit, but they can kind of take this asset that's sitting in the drawer not doing anything and now add the benefit of an LTC rider, then ultimately go to charity. And I think that's really kind of a neat way to make sure people know they've got enough money.
So they still hold it though? And
Yeah, in
hold
that
it
case, they
themselves?
still hold it, and they're not giving it away. They're actually keeping it.
If they don't use the LTC provision, they don't lose it.
Right.
They don't lose their cash, so that whatever's remaining and they didn't need it can go then.
And if they do need it, they use it up, and maybe the charity doesn't benefit, but they know they've taken care of themselves. For people that just don't have a lot of excess assets but are charitably inclined, I think that's kind of a cool idea.
I like it because if I don't use, I really want to do it, but I'm still not sure if I'm going to need it or not. Now,
Right.
if I don't use it, it can go on to the next to my next charity, to the charity of my choice.
And we could even do a life insurance with accelerated benefits kind of thing. We're building cash values and have an even higher gift to the charity. I mean, those are two things.
Well, give me an example of that because I think that's something that is new to a lot of our producers. Not the accelerated benefits, but how that works with the charity.
Well, in this case, the same thing as the annuity. There won't be a deduction. It's going to be held personally. These are for lower net worth people that just don't have a lot of cash. So instead, what they do, they start to take assets and start to make contributions to a life policy, building up the cash value. Here at Brokers Alliance, you would design it to maximize the cash, minimize the insurance, and throw an accelerated death benefit rider for the long-term care or for terminal illness or for critical illness types of things. So the client still has that pool of money, and they get access for their personal needs in retirement for those medical tragedies. And then ultimately, when they're passing away and they're taken care of, then it goes to charity. And now just instead of the cash value, you get a death benefit. And so if this happens early instead of later, there's this windfall for the charity. What a wonderful thing that would be.
No, I'm
For the
looking-
charity, anyway.
Yeah, for the charity. Yeah. He died. That was great.
Great planning. Let's die to
Wow.
give to charity. Oh, now there's a big heart.
Hey, don't forget the 2-year exclusion. Okay, I'm just saying. I don't. Oh yeah, I can just see it now. We just got sued because we didn't talk about that provision. Yeah.
Oh, yeah.
All right. Well, I'm thinking about. We have one product, and I'm trying to stay productless on my show, but I can't help it. We have a product out there right now that's a huge guaranteed universal life contract that I noticed that if you give a single deposit, they actually will be able to return the deposit 10 years later, and the death benefit still stays on to age 120.
Yeah.
So now we're doing something intermediate. Usually everything we're talking about thus far has been futuristic for the charity. But now I can say, here's the future benefit for the charity, but there might be an intermediate benefit because I'm going to make the donation, they make the purchase, but then after the 10th year, the actual product is so priced, and this is on the guaranteed side, not on current company assumption. So this could be huge. Wow. If you put $1 million in 10 years later, the charity can take it out and they still have their future all the way out to age 120, but yet they have the original principle in hand.
That's cool.
I mean, Ken, now that's cool. See, now I got to speak about something I know.
And
right?
see, that's why I adopted you as my mentor many years ago.
Well, thank you
for those creative thoughts. It's fun to see.
Because it's all about, there's only so many moves on the checkerboard, right? Once you've learned them, you've learned the IRS code. You are reading tax facts for your recreational vocational reading. I mean, Ken's in his hammock on the weekends reading tax facts and texting me how wonderful it is. You're a sick man. But I'm on the other side reading everything I can on product development, actuarial science, and all the things that intrigue me about human longevity priced on a timeline, right?
Well, in your own way, just as sick as I am. That's all I can say.
We're sick. Yeah, in fact, actually, the other day, somebody said, Steve, you seem to be intelligent. I said, no, I'm as dumb as dirt. You get me outside this area. I'm really not that great. When we're talking about all the things, and I always like how you keep pulling back to middle America because I keep thinking, well, charities for the big boys. Right, people that have serious money. But you keep saying, oh, no, wait a minute, hold on.
I had a very interesting luncheon conversation probably 30 years ago, and I still remember it today. And this guy sat down, and everybody's focused on the top of the pyramid, that very small top of the pyramid, which are your high net worth people. And we talked about how to get to those folks and service their needs in this area. But when you get down to the bottom of the pyramid, you have this huge, huge base of people. And there's a lot of people in middle class that want to do good things, and they don't feel like they can make a big difference. And I love the fact that we can help use the tax savings, the income tax savings on qualified plans, and help these people do some good in the world and feel good about what they're doing.
We're talking about, and I mentioned this at yesterday's close, big hearts, small wallets.
Yeah.
The heart's there. benevolency's there, giving's there, but they're concerned about, do I have enough for retirement? Because I don't know what my life expectancy is going to be.
Right.
Here are some really great tactics for middle America, people who really want to give, have a heart for it. We're in the season. This is the reason, right? And so I'm looking at always cool ideas, and you're making so many of them, like, I have an IRA. Maybe I don't need it all.
Right.
Could I, and how, maybe I could play with my RMDs in some way, right?
Well, and what's interesting is this is a true story. One of my best clients, we looked at his portfolio, and I noticed that he was taking money out of his IRA to give to charity, right? And then he was
after he was paying the taxes.
well, actually, he was taking it out to live on at that time. So he's paying taxes on the distribution, right? And I'm saying, gosh, you've got these capital assets over here with tax basis and a 15% capital gain. Why don't you take your earnings from there and then leave your IRA and let it build, and then ultimately just leave it to charity, because I know you want to give a lot of money.
Right. That's why Ken's on the show, because we're always looking for different ways to play with the assets that we have in hand. You'll be able to catch our show today and all our shows on HD 1080p right on our homepage on the on-demand section, right at www.brokersalliance.com, and all of our social networks, YouTube, Vimeo, Facebook, LinkedIn, and Twitter. We're going to be all over this tomorrow. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance.